Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Brian Stutland. He's managing partner at Equity Armor Investments, as well as my CNBC contributor and chief strategist at OptionInterest.pro. We're here to discuss the sustainability of momentum in the market, consumer sentiment, and notable options activity. It is great to see the both of you, as always. Welcome back to Trade Talks. Brian, let's kick this off. Decoding the macro trends that we're in right now. What can you tell from volatility that you're seeing? What's happening in the VIX with this post-election run-up and where we are now? Is there anything that we should be paying attention to that could possibly halt the momentum in the market?
Well, certainly just the mere fact that we've had such a huge trend and move up in the market since the election that it just seems a little bit overbought from a technical standpoint. But then, taking a look at the macro environment that we're in right now, we have still geopolitical concerns. What's going to happen as the Trump administration transitions over come January? How they're going to handle the Ukraine-Russia situation, what's been going on in the Middle East is a lot of concern. And it's interesting that given all of this and the huge run-up already, a fair amount of call buying going on in the S&P relative to what we saw maybe a month ago. And it seems like a little bit of over-exuberance to me, really. When you look at it, the VIX trading in the mid-teens right now, options trading at premium levels where I would be buyers. I would be looking to buy insurance on a portfolio right now because given the huge run-up and the uncertainty, look, Trump's going to step in January, and day one, there's going to be some changes made. There's going to be some suggestions of what's going to happen in the tax code going forward, whether the Trump cuts will remain intact. Will they be further extended? Will they be deeper cuts? So all that uncertainty to me says, I want to be hedging right now. I want to maybe take some profits. We've had a big run up. We're getting to the end of the year. I think other traders are going to be cognizant of taking some profits.
Yeah. And Brian, we'll get into earnings in a moment here, but when you think about it from the corporate perspective, being able to project, not fully understanding what the tax situation could look like or how that can potentially impact margins, whether it's because of taxes or tariffs and so forth, it's got to be challenging to, project what your full year is going to be once these companies start reporting in the first quarter to wrap up 2024 numbers and provide that kind of guidance.
Well, Jill, especially like you mentioned, the tariffs, like what kind of effect is that going to have had? I've heard so many different numbers back and forth from different analysts, whether, this is going to create inflation or no, it's not going to do anything because market demand is pricing things as it is. This will just be a tax sort of inflow for the U.S. So a lot of uncertainty around there will help determine. And then we have sort of this underpinning like little bit of softening economy, maybe when it comes to the consumer discretionary. I know we're going to talk about that, but also when you look at it too, the unemployment rate's still staying steady. So that part is strong. So a lot of mixed things. I think come end of January, we're going to get some clarity, but headed into that, we'll have a few days, a few months really after that point where we just don't know what's going to happen with earnings.
Right. And we'll pick up that conversation in a moment on the consumer. But Mike, when we take a look at the Nasdaq, right, trading near all-time highs, and you have noticed some massive options activity in a handful of these Nasdaq 100 names, what sticks out to you in particular?
Well, I think some of the biggest and most obvious names are obviously the ones that we're gonna be talking about. I mean, obviously we've seen a lot of activity in Nvidia. We've seen a lot of activity in Tesla. We always do. Those are typically 1 and 2. But this week we also saw Alphabet, between their voting and non-voting shares, which is the voting shares being Google, G-O-O-G-L, and non-voting and G-O-O-G. Those things traded about 2 million contracts yesterday, and I think there's really a couple of things going on there. First of all, the news about their Willow chip on the quantum side, I think, was very promising. And, that's really something that a lot of folks are going to be looking at. People who are in the crypto space are obviously a bit anxious about the development of quantum computing, but I think it's an important and powerful technological development that's going on there. The other is that they backed Waymo, and of course we had some news from General Motors in the form of their decision to abandon Cruise on the technology side. Alphabet as an investor on the Waymo side, they're potential beneficiaries of that. And we also had the news on Broadcom. I mean, Broadcom numbers were pretty great, and that stock's doing exceptionally well. So, I think we're continuing to see from the winners some pretty good news. I'm with Brian in the general sense, which is that if you take a look back and go back, say, 25 years or so, maybe even a little bit more, we'll go back into the 1990s, valuations for the S&P really haven't been at these levels if you're just looking on a trailing price to earnings basis, but for a couple of times. And at least 2 of those instances, we don't have to count really, because the GFC the earnings were dragged down materially by financials. So I'm not going to really count that. That was sort of an isolated incident. And then, of course, the pandemic plunge, a very similar dynamic going on there with the shutdowns. So really the only period when we have seen multiples, at least within my professional life, that were higher than they are right now was the late 90s and into early 2000. And I don't think that's going to give investors a great deal of comfort. And, you know, I'm kind of with Brian. I think owning a little bit of protection isn't a bad idea. You know, just yesterday I was buying some SPX strangles, probably hedge those out. We do the same thing in Nasdaq, by the way. NDX is probably a decent way to do that as well, if you happen to be more focused in that index rather than the S&P.
Yeah. And Mike, let's talk about the consumer and also earnings that are coming up. And you had mentioned, you know, when you think about trends over the past 20 to 25 years, let's kick this off with FedEx, because FedEx has traditionally been a great barometer for the economy just based on trends that the company was seeing and judging by shipping and so forth. We know that has, you know, the calculus has also changed just because consumer trends have changed, right? So what are you going to be looking for in FedEx as the company, you know, is evolving with the trends that we're seeing now?
Yeah, I mean, as you rightly point out, the transports, you know, people have often said, as go the transports, they're kind of the canary in the coal mine for the broader economy. I mean, the U.S. economy is 70% consumer, and of course, FedEx had benefited for quite some time from the secular tailwind that basically online and, you know, B2C business basically represented. Now, they have taken on a lot more competition more recently from Amazon. So I'm not sure that this is necessarily going to speak to the consumer overall, or maybe to the Amazon consumer specifically, because they obviously could cut out FedEx essentially as that important intermediary. And if we're all wondering about the day that we're actually going to be receiving drone shipments, and if it does go in that direction, I'm not sure that FedEx is basically up to speed on that. But I am a little bit concerned when I take a look at the consumer trends generally, because what have we seen? We've seen falling savings rates. We've been seeing rising credit balances. We've been seeing rising credit delinquencies. We've been seeing rising auto loan delinquencies. And auto loan delinquencies in particular, I think, sort of speak to the health of the U.S. consumer. And why is that? Because that's one of the last things that consumers are willing to forego their payments on because they rely on their cars so heavily. So when you see that kind of thing creeping up, I think there is reason for concern. So you take the high valuations, you take the distress of the consumer, you know, all of those things I think are going to be a cause for concern on the consumer discretionary side. And FedEx, this thing has chopped around so violently. It's moved 12.5% on average the last 4 quarters. I think we're going to see a big move again this coming week.
Yeah. And Brian, let's talk about Darden restaurants for a moment here. Again, retail, the haves and the have-nots. And back to our point in the beginning, you know, if you're unsure what taxes and tariffs and how that's going to impact your strategy, clearly corporates don't want to see their margins compressed. So the cost has to be brought somewhere else, and it usually passes down to the consumer. And I think, you know, discretionary names such as restaurants, that they need to be aware.
Yeah, they do. I mean, it's interesting. Like next week, you know, we mentioned FedEx, Darden also reporting next week. So a handful of other consumer discretionary stocks reporting. Darden's one of those UBS analysts coming out, and actually, it almost felt like a downgrade a little bit. You know, they were actually projecting same-store sales to be only 1% year over year, whereas analysts are looking about 1.7%. So that certainly is a little bit concerning that things are slowing a little bit down on the consumer. I mean, look, prices have gone up so tremendously, especially food prices, when you really scope everything out here. I mean, you could talk about the CPI. Oh, it's kind of coming in line at 2 or 3% year over year. You know, we just got a number out a little over 3%, you know, ex food and energy. And but the food part has really been volatile. And can the consumer really sustain? Can it eat out in luxury? And so we're going to get that kind of reporting. I mean, Darden's one of those names, really implied move in the options. Implied moves in the options market, expecting about a 5% move in Darden after earnings. So again, there's another name. Mike talked about FedEx. You know, I wouldn't expect a 12% move like FedEx, but a sizable move in Darden probably post earnings to get some clarity going forward. And there is a little bit of concern to UBS analyst side that they can actually achieve these, maintain their forward PE of 17. That's kind of high, like Mike talked about. The PE is being relatively high right now, especially in a consumer discretionary stock that's just, you know, going to eat out at restaurants. The expansion there is not quite what I'd expect.
Yeah. And Mike, let's go back to another bellwether here for a moment, Nike, right? I mean, essentially Nike would dictate the trends in athletic wear. And now as consumer preferences have changed and with social media and influencers having such a big impact, that's a lot when you have to think about your innovation strategy.
Yeah, I mean, I think you're really hitting on a critical theme right there, which is, and actually, I think I was talking to Brian about this when we were on a call earlier this week. If you go back 10, 20 years, consumer trends with respect to things like shoes and athletic apparel were probably going to be dictated as much by whether Michael Jordan was wearing them, whether you saw them in school and so on. Now, is it in a TikTok video? Is it in the latest YouTube thing? And one of the things we have certainly seen is that even amongst basically the buyers of these types of things that aren't watching TikTok videos, there is new innovation. Think of ON Holdings. ON Holdings as a shoe company has absolutely taken off. And Adidas has improved their sales somewhat materially. All of that said, where Nike is concerned, Elliott Hill coming into the company after having retired. So he was really a candidate for CEO in the past. He had 20 years at the company, during some of its best years, it should be said. And when he got passed over for CEO, he retired. And now they're bringing him back. I think that's a positive because he has had the opportunity to witness from the side what doesn't work. He knows from the inside what does work. And, I think this is actually a good person to bring in. He also knows the machinations. He's worked in so many different areas of the company. And it's trading around 17 times or thereabouts on a trailing basis. Now, I will say this. Alternative data for Nike isn't that great. If we take a look at the foot traffic from like Placer AI, or if we take a look at the credit card transactions, that hasn't been looking that great. It's been trending down. But it does look like they got some decent numbers last week. At least the sample data is looking pretty good. And that could potentially bode well. So I'd be very interested to hear what Elliott Hill has to say. The fact that the company's trading cheap to its historical multiple, I might be cautiously optimistic. I probably wouldn't reach out and buy the stock here, but I might buy call spreads.
Yeah, it's so interesting because anecdotally, I worked in World Foot Locker and Champs in the late 90s, actually for a good part of the 90s, while I was in school and so forth. And when we would have the merchandisers come once a quarter, sometimes once every 6 months, that was a huge event for the stores because that was the look into the next season. It wasn't necessarily something where it's on demand like it is today. So I find, the evolution of the consumer and these trends to be quite fascinating, having worked many hours in the stock room, putting that merchandise out there. Let's shift gears for a moment here and talk about the semiconductor space. Kicking it off with Micron, let's get into some recent options activity here, Brian.
Yeah, well, it's interesting. Micron's going to report earnings next week, and we just got Broadcom recently, which tremendous earnings, stock up huge today. But Micron's one of those names, really, forward PE of 11 only, right? That to me, that seems cheap because when I look at the net income, they're expecting about 1.4 billion in net income, and that analysts expecting that to grow by 2026 to 14 billion. So they really have benefited from this AI play, right? I look at it almost like comparing like a race car. The NVIDIA chip is the engine. How fast can it go? Micron is really like the storage, the gas tank, storing that information, that data, and getting that information out to people. So that is a critical need in the AI play. We'll get some understanding there. When I look at this stock, and I look at the open interest for next weekly options expiring on Friday, huge amounts of open interest right at the $100 strike, and also a very big uptick in call buying, call trading, that is, relative to puts. That's trading at almost 3-to-1 ratio right now. Historically, that trades about 2-to-1 calls to puts. So when that happens, what we typically find is we look at the big open interest strikes, and that strike no longer acts as like a magnet after earnings, but actually almost a repellent. So I would expect things to really move off this $100 level for Micron here. And certainly you look at what Broadcom has done today. I'd be looking at, potentially buying options, looking at ways to control risk here because I do expect a decent sized move in Micron.
Yeah. And Mike, let's talk about the broader semiconductor sector overall. I know you love all things tech, but let's also incorporate the impact of AI, what that looks like going forward. And when you think about it, there is really almost, technology warfare going on for the race to meet all of this demand.
Yeah, I mean, it's interesting, of course. A company like Micron is more, their product offering is more of a commodity than it is for a company like NVIDIA. And, that's one of the things that they have to deal with, which is sort of the commodity price for their products. What does DRAM pricing, for example, look like? So in NVIDIA's case, because there isn't any really replacement for the things that they're doing. If you want Blackwell chips, you want Blackwell, and that's the only thing that's going to get the job done, which is also the reason why they have 74% gross margins, which is obviously a very nice place to be. It's interesting, though, because there is still, and it doesn't matter whether you're talking about the existing sort of framework for AI data centers, or whether you're even talking about the need for chips in quantum computing, which we touched on earlier. There is actually a need for conventional chips within quantum computing as well. So any of these build-outs are going to have carry-on benefits, even for existing players like Micron Technologies. AMD is obviously trying to bridge that gap. They're trying to go from sort of the commodity side on the chip space over into having more proprietary and sort of AI-dependent technologies. But I mean, I think that the fact is that we're going to see a really big evolution in robotics. We're going to see a big revolution in AI and data center, and we're going to see quantum computing. And I think that a lot of these companies, including Micron, are poised to benefit.
All right. Appreciate both of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.